This year so far has proved a tough year for investors. Since December, the Australian All Ordinaries Index is down around 11%, the US 500 is down around 18%, the Nasdaq is down a whopping 33%, and this is the same story across most of the stock indices around the world. And even if your portfolio was a little bit more defensive in nature, you probably still would have felt some of the pain, because bonds have been sold off as interest rates rise, and cash, well, with inflation currently running at 5.1% in Australia, the value or the purchasing power of your cash is actually going backwards. So yes, it's been a tough start to the year for investors, but let's remember that investing is not a one-way street. It has its ups, it has its downs. But what I really want to talk about today is what's to come. What's the outlook from here? Are we over the worst of it, or is the worst still to come? Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about the current market volatility and what's expected to come in the future. Well, I'd love to be able to sit here and tell you exactly what to expect moving forward, but the truth is, I don't know. Unfortunately, no one knows. Everything we do is based on predictions at that point in time. But what I do want to do is to point out some of the headwinds that investors are currently facing in this market. And just a pre-warning, there are a few of them. High inflation. Australia's current rate of inflation is 5.1%, and this is the highest it's been since June 2001 when the GST was introduced. Increasing interest rates. The Reserve Bank of Australia surprised us this month with a higher than expected increase of 0.5% to the official cash rate, bringing it up to 0.85%. Many are predicting that it'll be above 3% by the end of the year, which would put the variable home loans somewhere in the range of 5 to 6%. Now, Philip Lowe, the head of the RBA, actually came out last night and said that he expects inflation to be somewhere around 7% by the end of this year and the official cash rate to be somewhere around 2.5%, which is less than what some of the economists are predicting at the moment. Quantitative tightening. This is a big one in the US where quantitative easing could switch into quantitative tightening. The Federal Reserve would stop buying bonds and maybe even sell some bonds back into the market or simply leave them there to mature. Lower real wages. Wages aren't rising as fast as inflation, which means people's purchasing power is actually going backwards. The lower consumer confidence. Consumer confidence here in Australia fell 5.6% in May. This means people are less likely to spend and invest, slowing down the economy. And of course, the risk of recession. The US has already had one period of negative GDP, and it's not unlikely that they will have another, causing a recession. If inflation remains high and economic growth slows, then we are potentially facing a period of stagflation. All of these risks are interrelated, and it really boils down to the fact that we've just had a period of massive stimulation in financial markets with quantitative easing and historically low interest rates. And unfortunately, to put it simply, the party is coming to an end. Central banks have decided that inflation is now a problem and they are going to fight it. And the real risk to financial markets at the moment is how aggressively they take on that fight. If the official cash rate and interest rates continue to rise a little bit and inflation starts to fall down a little bit and they meet somewhere in the middle and we have a neutral interest rate policy, well then that's probably going to be not such a bad outcome and it should be a fairly soft landing. Under this scenario, there should be a good foundation for businesses to rebuild and consumer confidence to come back, which should in turn lead to higher asset prices. On the contrary, if inflation remains high and even worse gets higher, then this is probably going to lead to more aggressive moves by central banks, which can be recessionary and bad for asset prices. For me, the biggest determinant that you need to make in your portfolio and your financial situation at the moment is your time horizon. That is, when do you need the funds that are invested? And if your time horizon is less than 5 years, well, you should incorporate defensive assets into your portfolio to accommodate that need. And the silver lining is, as interest rates continue to rise, you can start to generate a better yield on your cash and your bonds, those defensive assets that you're holding in your portfolio. On the other hand, if you have a very long investment time frame, so you're planning to invest for 7+ years, then you should probably just accept the current movements in the market, because at the end of the day, volatility is part of investing. Don't get me wrong, it definitely hurts in the short term to see all of your past profits disappear. But you have to remember that as an investor, your job is to collect a pool of high quality, diversified assets. And when there's a pullback in the market, it means the cost or the price at which you pay for those good assets has reduced. So if you're in a position where your debts are under control, you've got good cash flow, you're able to invest more, well, then you need to look at things, market pullbacks like this, as a bit of an opportunity to continue building your basket of assets at a lower price than you could 6 months ago. This is definitely not the kind of market to be making brave moves. This is the kind of market where you reflect on the intentions behind your investments, you review your investments to make sure that they are diversified and high quality and you're comfortable with everything you hold, and to just focus on the medium to long term and continue to execute your financial plan. Your moves should be dictated by a financial plan and not emotions based on current market conditions. But that's it for me today, guys. Thanks a lot for watching. Leave your comments down below in the description box as to what you think Mark's gonna do moving forward. I'm guessing there's probably gonna be a few bears out there, but I'll be interested to hear your thoughts. I'll see you guys in the next one.